Okay, business strategy and the drivers of shareholder value. And thank you for coming. I realize we are a little bit late, and I need to manage that for next time. The rules of racing, and welcome Tracy. I saw you last time, but for the new folks, just welcome. Be open, be honest, respect the opinions of the other group members, be constructive, and most importantly, be a participant and an observer. So you listen and contribute. The lessons work best when we're having a dynamic conversation. But mostly it is an online session, and I'll say things that will jar with you, and you'll say things that will jar with other people, and we just roll with that. That's pretty much it. The philosophy is that I'm running these sessions every second week, 13th, 27th, 11th, 22nd, etc. And then on the middle week, I have a repeat session in the evening. And I'll probably bring this slightly forward. Instead of a 7:30 start, I'll have a 7 o'clock start. We have a better turnout in the mornings, but I'm trying to find my evening time that actually works for people to attend. So this session on the 4th will be a 7 p.m. session, a repeat of today, and so on and so forth. And at the end of March, I'll see whether I just go through the whole thing one more time, see what happens. So that's where we are. And for next week is customer value management. Getting back to today's session, an introduction to the drivers of shareholder value. Let's go. These are 4 slides that really build together. And the idea is, what are you trying to do with shareholder value? What is one of the primary motivations for shareholder value? And I'll start with to gain a competitive advantage within the industry. The blue does sort of tell a sentence. You need to the enterprise needs to determine its current competitive position. You've got to know where you are. That's important. So you can develop a strategy for improving that position. You must be effective in all areas that are critical to their success. The enterprise must be effective in all areas. Let me read this. To gain competitive advantage within the industry, enterprises must be effective in all areas that are critical to their success, and they need to exploit those advantages. You need to understand what your advantage is. You need to exploit that advantage. An enterprise that has a competitive advantage when relative to its competitors can deliver a product or service at a lower cost with unique benefits that justify a higher price. So you're getting an increased margin. You're delivering products and services at a lower cost. You're not competing hard, right? You're now exploiting your competitive advantages. And finally, the ultimate objective is to achieve profit goals that meet shareholder objectives on an ongoing and predictable basis. So profit goals that meet shareholder objectives. What is the profit that shareholders are expecting? Because shareholders are investing in a company, they're expecting a return from that company, right? It's a financial return. We want a return on our shares, on our investment. And really everything rolls up to that. And we're going to talk about how we make that happen. But this is your umbrella thinking that we are trying to create a return, a sustainable and ongoing, predictable return for our shareholders. So they've got an idea about their forward financials. And it's an interesting way of thinking about shareholder value, just taking it back to really simple 101 type concepts. So what are the determinants of shareholder value? There's 4 under this model: profitability, productivity, growth, and economic cash flow. And I call out Michael Halliday. He first introduced me to this model nearly 20 years ago, and I found it to be extremely robust, and it stood the test of time. And through the next half an hour or so, I will take us through all 4 pieces, but with a particular emphasis on the first 3. I actually wrestled as to which lever to start my conversation with, and we're going to start with productivity. Productivity is the business. This is the business you guys work in. So how do you make your assets more productive? How do you get a greater yield from your assets? How do you make them work harder? Because if you can make them work harder, you are getting more out for the same input. So therefore you're selling more. So you're getting more return from the market with the static cost, or in fact reduced cost if you are improving productivity. But where are you going to sell your products? Well, that's an interesting question. So that comes to growth. Where is your growth market? Which market do you want to play in? Where do you want to go and sell? And then once you've worked out that, you say, how am I going to compete? So profitability is all about how you compete in the market. Growth is which market? Profitability is how you compete. Productivity is how you turn that market demand into products and services in the most economic means possible. And then economic cash flow is how you pay for it all and how you set yourself up to have cost-effective investment or borrowings or debt, or whether or not you can pay for it internally with cash cow type products, that sort of thing. So those three are working together quite well, and economic cash flow is how you pay for it, how you invest. It's your finance decision. So really just summarizing your productivity, what you're trying to do is increase productivity in the organization by determining how you can increase demand on your organization, as in how can you compete better in the marketplace. So you've got to know which marketplace you want to compete in, and then you've got to know how you're going to compete in that marketplace. Reasonably straightforward, but just keeping the concept more simple. For the first three, profitability, productivity, and growth, you've got marketing decisions, you've got investment decisions set in the sense that I need to invest in my organization, I need to invest in the market, understand how I'm going to develop that market, and marketing decisions, how I'm going to compete again. And then the financial decisions is how am I going to fund it if I need to borrow money or not borrow money, but raise money in order to get into those markets. So those four will work together, and we'll jump into them shortly. Just taking it down one level, from a growth point of view, from market, I'll go from right to left. From market to growth point of view, you say, do I want to differentiate or diversify? So differentiate, do I want to stay in the same market and be slightly different, or do I want to diversify, introduce new products, or jump into new markets? Right, so differentiate, how am I going to be different in the same market? Diversify, am I going to jump to new markets or introduce new products? So we'll talk to that. Then how do I compete? So this is your 4 Ps that you learned at university: your product, your place, your promotion, your price. How do I compete in the market? And therefore, how do we introduce demand onto the asset base? How do we make our asset base work harder? And coming back down to the financial decision, the discount rate, the cost of capital, how do we set our profile up so we can get better funds? And effectively what Donald Trump did in the States, if you believe the press, and I'm quoting the press, not an opinion so much as he went and elevated the value of the Trump portfolio in order to get a better cost of capital from the banks. That's what they're chasing him for. So he effectively manipulated this model to suit. He's being called on it. We'll find out whether he is true or not. I have no opinion. So let's talk through productivity. But before we do that, just a shout out to you guys. How did that make sense? And Rachel, I appreciate you don't want to wake up everybody in the house. So I won't ask you to contribute. But Robert, Tracy, thoughts on this model? What are your initial thoughts?
The framework that came to my mind is, on the topic of productivity, what I learned early in my career was the term earn versus burn.
Yeah.
So doing more with less. A swimmer, can the swimmer travel the length of the pool with fewer breaths, fewer strokes?
Yes.
So earn versus burn is a cute term for measuring productivity.
And that language you use is exactly right. Do more with less. That's key. That's quite central. And I deleted a slide for efficiency of slides that had those exact words on it. So we're in agreement. Tracy, any thoughts?
Yes, actually, Robert made me think. I feel like I'm taking fewer and fewer breaths every day as I'm swimming down that pool. Interesting that it's been the driver for so many years to do more with less. but we've just then introduced a whole lot of other issues that go with do more with less. But that's what I'm looking at it with a sort of people view, because I'm trying to look at everything now with a people view, and it's a good framework. I think it's great, but it is part of a bigger ecosystem.
It is part of a bigger, and that's what you've got to realize, that productivity is always part of something bigger.
Yeah.
And that's what the session's about.
Yeah.
But we'll get to the people point of vieu as well.
Yeah, sorry, I didn't mean to jump ahead there, Garth.
No, not at all. So we'll get into productivity. Let's talk through that. And the principle is do more with less. And specifically, we talk about this graph and we say, how do we differentiate ourselves in the market at the moment? So we've got a point of differentiation. Buy our product. It's super blue. It washes your clothes whiter than white and all that point. We have our point of differentiation. And depending on how high you make your differentiation, depending on how specifically unique you make your product, typically your cost of production will go up. If it's a single one-off product, it typically costs you more to make it than if you mass-produced and have no differentiation. You can do that very cheaply. So you've got high to low and low to high, and you'll be sitting somewhere on that curve. And what you're trying to do is find a way to reduce your cost of production. You're trying to increase the burn as such. You're trying to maybe keep your same point of differentiation, but increase your productivity. That's where you go. Now, that's organizational, internal transformation and change. That's what you're doing with your change programs. You're introducing technology or IT programs that are, in theory, making your organization more productive, and you're reducing your cost of production, or you're introducing different products, you're diversifying or differentiating and introducing a mass-produced product or a much more differentiated product, but you're trying to do it by utilizing your existing supply chains, your existing framework. So instead of being that expensive, you can do it slightly less expensive and take the margin. And if you can achieve from the yellow to the green star, that's all margin. That's just pure margin for you. You've now just increased profitability, shareholder value, because you're in theory selling it for the same price, the same point of differentiation. You're just making it cheaper. So this is what from a productivity point of view, as you are putting more and more demand on the business, if you can be pushing more demand and reducing your cost of production, you've done particularly well. So that's your transformation. That's your change philosophy. Parallel to that is your customer view. So you've got your differentiation. How do your customers see you? And the idea of do more with less, increase profits, margins, and growth. But what's with your customer values? It's I want, I need, I'd be delighted by. So treat me as an individual. If you go down to mass production, if you go to mass production, it's very hard to treat your customers as an individual, trying to be quite specific. But if you're an architect and you build a house for them, then it's very easy to be very specific and treat them as an individual. And some in the middle, you have your boutique hamburger shops that when you walk in, you can order the brown bread roll and you can order your meat, medium well, and have onions or no onions or tomato sauce and barbecue sauce. And you are treating them as an individual in that space. The problem is there's quite a lot of conflict between those two. You can't be all things to all people and do more with less. That is, unless you get this jump right. So this is where your customer value management comes in, that you can, in fact, do more with less if you can get that jump right, because you haven't changed that. Or, in fact, you may become even more differentiated, really respecting the individual, but it hasn't cost you as much as you would have thought it would otherwise. So you'd be more efficient in your growth. So you're looking to manage that conflict and not only do more with less, but also treat me as an individual, understand the customer values. So differentiation needs to take you in the right-hand side of here. We'll talk a bit more about that later on, but in more detail. But at a production level, from a strategy point of view, remember we're all in productivity at the moment. How do you achieve that, do more with less? How do you achieve the yellow star to the green star? You've got two filters that you look at the market in. One is the production capabilities, your process and product solution, everything from a stable process product from mass production through to mass customization, invention, and continuous improvement. So one point is understanding what is your current production capability. Really being clear on that and making sure that one shoe does not fit all, because different market segments may require different production capabilities. And the other one is, how do we sell? What's our market position and our customer perception? So if you can be pushing a commodity product, a perception of a commodity product into the perception that it's a quality product, you can now charge more money for that, right? It's still really a mass-produced product. I mean, Lexus is a mass-produced product in many respects, but its perception is a quality product. So they keep be producing it through mass production. It's cheap as chips, but taking the financial premium of a quality product. And what happens is you can say, how do I want to be perceived in the market? And then choose whatever production capability you like. And most often you want to choose to mass produce. You want to push as much of the process into mass production that you can, and maybe only have a unique front end and back end that the customer thinks they're getting a tailor-made solution, but everything in the middle is mass produced. So separating your marketing position from your production capability and being very clear that you don't have to be tailor-made, mass customized. You could be tailor-made, mass produced. And that allows you the freedom of mind and thinking to go from the yellow star to the green star. To say, okay, how do I drop the cost of production? How do I change how I'm producing versus how I'm selling? Two different views. And this is why I'm setting this up here, because we'll go to growth and we'll go to profitability, which talks to sort of making these products come alive. Tracy, you spoke about operational stuff. Because this is productivity, I just bring in these next two slides. When you've thought through your production capability, mass production, continuous improvement, invention, and mass customization, process organization, information technology, you have to be very clear as to what production capability you are using, because the organizational design is very different depending on the production capability. And organizations often don't appreciate that subtlety because they're so busy. They're so busy trying to get stuff out the door. They don't necessarily take the time to realize that one shoe doesn't fit all, especially in the small organizations where they just all come in and work in gram. You've got to say, all right, if this product is a mass-produced product, we need a hierarchical top-down. We separate the performers from the thinkers. It's mass production. Just we push it on. But continuous improvement, you are now looking at a thinker on the production line, on the service line. You're looking at somebody who's looking to improve things. So you're combined performer and thinker roles. And now you've got to be talking to the people differently, and you have different job profiles. You've got to have different management structures, a different way of treating those people. Invention is collaborative professionals, they're craftsmen. And mass customization is highly responsive workers and work groups. And taking account as to saying, in this part of my business, am I using mass production, invention, continuous improvement, or mass customization? And therefore, does my management structure suit that type of production capability? That's quite key. And the process as well needs to be quite different. This one is process, mass production, centralized control. This continuous improvement is constant micro transformation. You can think through the two labels that gets you there. Decentralized to specialized individuals and groups under invention. From accountabilities, I won't spend too much time here, but again, the accountabilities change from managers to workers to both. And the mass production is very much a task-orientated. Continuous improvement is doers and thinkers, workers and thinkers. Invention is self-directed, and mass customization is hubs and complex webs of activity. So these guys are working in a mass production, mass customization point of view. Does the accountabilities that they've been provided allow them to work like that? Because if it doesn't, that idea of do more with less, of reducing your cost of production, you're unlikely to achieve that because your management philosophy, your management style, your approach to management is actually impeding the objective that you're seeking to achieve. So these two slides work quite closely. You've got to be thinking through that, and that's as far as I'll go. I've got a whole session coming up early next year on the operating model where we dive into this a bit further. But in terms of operationalizing strategy, I thought that would be useful for today. The measure that I quite like is return on capital employed. It's the idea of, it's one of many ratios, but it's what sort of return are you getting from the capital you've employed? Capital employed is total amount of capital used for the acquisition of the profits. So what sort of profits am I generating? How much capital am I putting into it? And can I improve that? That's I do more with less. Can I use less capital, less infrastructure, and still create the same sort of profit or better? So it's also a measure of efficiency. So I quite like return on capital employed as one of my go-to ratios from a productivity point of view. I'll jump to growth unless there are any questions or thoughts. No. Okay. From a growth point of view, the growth arm, it's really what we're looking at here is which market are we competing in? Where do we want to compete? It's not how are we going to compete. That's under profitability. That's your marketing message, your price, your promotion, your place, etc. This is which market we want to be in. So remember now, we started with productivity and we said we're trying to do more with less. So we need to go to a market that there's opportunity to do more in. Right? We need a big market, we need an attractive market, we need a market with returns, a market that we can make decent profits out of. So which market do we want to play in? And we're looking at so which market is attractive and what will be our competitive position? We might only want to be in a market that is where we can be number one or number two. If we're not one or two, or we can't get to position number one or two in the next 3 years, we may not want to be in that market because we just can't get the volume from that market to place on our assets to improve our return on capital employed. So if we look at the balance between market growth and market returns, and so from a market attractiveness point of view, you've got the profitability, the productivity, and the economic cash flow. These are now, because it's growth is not on the screen, so I'm looking at the other three levers from a market attractive point of view, and I won't put you through the pain of listening to me to read all the points, but sort of cherry pick these things. But the key ones: high volumes of market size, high margins. We can get a decent margin. We can get it's a good sized market. You could say the market it's got 100 people in it. Each person will give me $100,000. Right, I've now made my $100,000 by 100 people, and that's it. The market's saturated. Or is it better to make $10 from 1 billion people? Does the market have size? Does it have volume? Does it have stable cost and low price sensitivity? So I can start turning up my costs. Once I'm established, I can start turning up the price, ratcheting up the price slowly, and I'm not going to lose customers. My costs are stable. I don't have to keep investing to compete in that market. There's high repeat purchases. I don't need to keep finding new customers. Customers are coming back to me. I've got repeat purchases coming through. I can integrate my value chains. I can be dominant. Reduced inventory, brand recognition. Brand recognition is actually really important in these sort of markets, especially in your international markets. My personal experience in the Asian and African markets, where some of the products can be quite shonky, brand value is incredibly important. People buy brands because they know they're going to get taken home and it's going to last, because they don't have a lot of disposable income. They've got to be careful how they actually spend their money. Right. So how are we going to make money? How profitability, the margin management? Can we have stable costs, low price sensitivity, people coming back so we not have to reinvest, productivity, economies of scale? Opportunities for value engineering, always adding slightly more value to the product. So treat me as an individual. We're able to do that without substantial changes to the product. It's stable, reduced learning. We don't have to keep teaching our staff. Again, the productivity costs are coming through. We're not reinventing the wheel over and over again every time somebody joins in that sense. And economic cash flow, we've got reduced risk premiums is key. The banks, the investors are looking at us and saying, you're in a good, stable market. We don't have to load up the money we're lending to you with a risk premium because we're very comfortable we're going to get it back. So it's the lower the cost of capital. And evergreen potential, does the market keep giving? Are they going to get their money back? So there's some nice ideas in terms of market attractiveness. Your competitive position, again, on those 3 points. Can you be in the dominant position? Can you have exclusive transferable brand strength from one product to another product? Flexible operating systems, pricing potential, etc. Productivity, scale of operations. Is it a market that allows us to scale what we're doing at the moment without necessarily having to rebuild a whole new product line or retool our factories? Scope of operations. Can we work with what we've got? The urgency of the market. People want to buy. They want to get in. There's a demand. There's active demand. And economic cash flow, again, stable. Large number of suppliers is important in the sense that you can't be held hostage by any one supplier, right? If this supplier ratchets up their costs, you say, fine, I'll take it from another supplier. So you've got the suppliers competing with you. So that makes it stable. That makes your cost stable. You know where you're at. You can't be held hostage. Large number of customers, you're less likely to hit a saturated point of view, and they're coming back to you. So you've got that repeat business. So these points all sort of overlap and talk to each other on a many-to-many basis. So but we've come back to, do we have a competitive position, and is the market attractive? And if the answer is yes, that's the market to play in. Now we've chosen the market, how are we going to compete? That's your next question. So this is the point I would like to give you today, in that separating your thinking, which market we want to play in versus how do we compete in that market. And while it's reasonably obvious, that statement, often people merge the two together in their conversations. So when you are having a strategic conversation, get people to be clinical in their thinking. Which market are we playing in? Why are we playing in that market? Why is that market attractive? How well can we compete? Right, so now we know why we're in that market. We know why we want to play in that market. Then we have a separate conversation that says, now we've agreed that market, how are we going to compete in that market? How are we going to make money? What are we going to tell that market that's going to cause them to buy our product? Are we differentiating? Are we diversifying? Let's be clear on that. So are we penetrating the product? Are we penetrating the market? Are we developing the market? And that sort of thing. How does it sit with our current messaging to the market? But it really comes down to this, the marketing mix. What is our messaging? How do we promote ourselves in the market? And what is our product? And particularly the augmented product. So the base product itself is very well known. But the augmented product, the services we wrap around it, the packaging, the services, the branding that you wrap around your product, how do we exploit that? And, from a service point of view, do we have to put in a more expensive post-sale service solution? Does the market need that post-service sales solution? Does our product need that post-service sales solution? Because that's expensive. That if you keep having to offer aftermarket servicing, that can get very expensive. So what sort of warranties are you wrapping into your product as well? So how do we get to the market? What is the functionality and the features and the extended features such as warranty around the product? How we convey our product to the marketplace, and then how we price. We're going in on a cost plus, and then growing it up into a value add and margin point of view. Once you have that dominant position, once you're stable, once you have really established yourself in the market, you can move to value pricing rather than cost pricing. And when you get to value pricing, you now can have quite a substantial jump in your margins, in your profitability, because people buy on the value and not on cost. But that comes down to, are we selling a commodity product mass production, or are we selling a mass customized product where the organization, we've managed to balance that do more with less philosophy, where the customer, we've managed to balance that do more with less to treat me as an individual. We've got that conflict well worked out. And when you've got that conflict well worked out, you can now start competing on value rather than cost, because the customer sees themselves as being treated as an individual, and they'll pay a little bit more for that. Provided the product is not too much of a commodity product, there is a ceiling. But then as you start to say, well, a McDonald's hamburger will always just be a McDonald's hamburger. There's only so much you can do with it. Brings us to this slide, which says, on this one I've got price and functionality. It's a fairly well-worn slide, but take stock as to where you are in the market. Right? Somewhere you'll be in this mix. And then have a look for the white space and say, if I reposition myself with my promotion, if I can take my messaging, my promotional messaging, and push my product so people perceive my product to be just slightly more to the top sort of rightish, I can increase my price by maybe adding a little bit more functionality, but the cost of adding that functionality is substantially less than what I can charge for. So here's a whole bit of white space that the market is not exploiting. Now, it might not be, there might not be enough buyers in that market for you to want to do that. But you start having a look at the white space, and you can't push yourself too far, because suddenly you become a different product. Suddenly people have a position as to who you are. So you can only move so far before you sort of break your position, the mental position people have for you. But other ideas of, keep your functionality, drop your price, drive volume, or actually reduce functionality and drop your price. Again, drive volume, but also reduce production costs. There's a whole lot of white space down here that could be exploited. So in this one, understand your white space and say, should we be competing in this close mix, or does it actually pay us to get into some more white space? Do we know where that white space is in our marketplace? Right over here, there's loads of white space. Nobody else competing here, so we just put our price up. Because anybody who's buying on that level of functionality, they may not want to jump all the way to there. So we have an opportunity to just ratchet up our price at 5%, 10%, somewhere over here. So we've got space to play over here. So understanding your white space it's a useful framework to have in mind, to say, how do we position ourselves? What is our message? What is A saying compared to H? What should we say differently? Like, buy us washing powder, we'll wash your clothes cleaner. Right? People want that, so we'll say that. Economic cash flow. Coming back to that. And each company will have its own financials. So I'm not going to talk too much about the financials themselves, but I would say your job is to be clear and to think critically through to be clear on the strategy and critically think through the associated risks and assumptions. So be very clear on the first three things we've spoken about, the growth, the productivity, and the profitability. And then think through the risks and assumptions, because those risks and assumptions are what's going to bite you financially. As we'll see later, the bus that runs over the pedestrian is never the bus the pedestrian was watching. Right? So, you start worrying about what's going on over there, and you get run over from somewhere else. Assumptions are risks, and it's important to see assumptions as risk. So we made these assumptions. Okay, well, how do we make sure those assumptions either materialize or don't materialize? But because we don't call them risks, we treat them differently. But assumptions are risks. An investment should only be undertaken if itself is profitable. So when you're looking to invest, make sure you're not cannibalizing your existing market. You're actually adding profitability, not shifting profitability. You're not taking away from yourself. And at the end, the net sum, it's a net benefit of zero, because you reduced this bit and you've lifted that bit. Make sure whatever your investment is increases the overall profitability of the organization. And as I say, the bus that runs a pedestrian over is never the bus the pedestrian was watching. So all financial investment models are built on assumptions. An assumption is a risk. Make sure that decision makers comprehensively understand the assumptions underpinning the financial model. Really exploit those ones. So when you get into these slides, you can say, how do I get reduced risk premiums? Will I have steady growth? What assumption am I making that will give me steady growth? Why is it a large market? It looks like a large market, but when you break it down, it might not be a large market at all. It might be lots of separate markets and people don't really move between it, but I'm using the wrong umbrella term. I'm using the fizzy drinks market rather than the diet fizzy drinks market, which is a smaller one. And diet fizzy drinks, people aren't ever going to buy, non-diet. So I've used the wrong term there. And, do I have large frequent customer transactions? What assumptions am I making? Yeah, there are lots of people there, but once they buy it, the product lasts for 15 years, so they're never going to come back, right? Because 15 years, we don't want to wait 15 years for the repeat purchase. So in fact, do we dumb our product down? Do we take some of the functionality out, reduce some of the functionality, reduce the cost, but that product will wear out in 3 years and we'll get the person back and we'll get a new purchase and get the new investment on top of that. That comes through. Let's have maybe a slightly more shonky product in the market. And we've all seen that in our own lives. The products we bought years ago just don't, the products today don't just last as long as they did years ago. This is sort of the thinking that's coming through. So these assumptions, when I talk about assumptions here, I'm saying look at that market attractiveness, look at the competitiveness, and look at those assumptions and say, do those assumptions stack up when I'm borrowing money and trying to raise money to fund this market and fund these strategic decisions? Guys, that's it.